here we are with Edward's question via email, and this is a question that many of you might have on your minds. So Edward asks, my concern is about management of positions. Under conditions of the last 2 days, where the consistent uptrending of the markets, there was a sudden and sharp decline followed by a second day of declines. Well, we jumped back at the end, but you can understand Edward's question here. What he's interested to know is what technical indicators do we use to decide to exit a position when these type of declines occur, especially if you're holding long call position with expiration dates within 60 days. More importantly, though, in addition, I'm interested in your recommendation for hedging positions to minimize the impact of these sudden drops. I have in the past held long VIX call options, but unless the decline is like we experienced in February 2020, the gains from the VIX calls pale in comparison to the losses in the long call positions. To make matters worse, as of the time I'm writing this, VIX is flat for the day despite the market sell-off, and then the market recovered a little bit towards the end of the day. Now, I didn't have time to put all of this into slides. We're going to use power options to illustrate this with a discussion of timing and hedges. And the answer to the first question, we'll look at this too, Edward, is regarding the technicals. Well, whatever technicals or fundamentals you use to get into a trade, those are the ones that you should use as a warning or exit if a trade goes against you. So for example, if I open my long calls where I look for the stock to be in an uptrend, let's say above an EMA 9 or above the SMA 20, okay? Or I look for a certain Bollinger Band limit or to be in a certain Bollinger Band range above the upper band or near the upper band, or if I use a MACD or an RSI. Whatever technicals you use to get in the position, if those technicals reverse, if my MACD goes negative, if the stock drops below the 20-day moving average, that's a warning sign. I'm not saying stop the position at that point, Edward. I'm saying that's a warning sign where you might want to consider making an adjustment, rolling the trade, adding protection to the position. In other words, think about it this way. You got into this position and the stock turned, not because of the stock is weak, not because the stock is necessarily bad news or suddenly became a bad stock. The market pulled it down. It was probably overbought at as many stocks were recently, and this is bringing everything down. So it's kind of a natural correction, really. So, but once you see if you look at your position again, brand new, you look at the stock that your long calls are under, Edward, brand new, and you look at those technicals, you look at the chart and you say, I wouldn't buy a long call on this stock because X, Y, or Z. Maybe that's a warning sign to get out of the position. Now, I'll tell you what I would typically look for as well. But first, we want to go ahead and take a look more at this position related to the management, more related to this. But let's take a look at the last 2 weeks, and I'll explain why I'm showing this chart. On 8/24, we had the SPY below where it is right now, is at 342. We had a good 7-day run up to 8/31, where the SPY is around 352. Not strong, but a good 10-point move, of course, over a 7-day period. And then we have another 6 or 7-point move in a 3-day period to Wednesday. And then that big drop occurred on Thursday and hit to the bottom here at the end of Thursday. This one I was looking at on the chart. It didn't load Friday's data in because I was using a custom and it wouldn't let me allow to 9/4. It only looked at historical. But at the end of the day today, we closed up a little bit from where we opened. We opened down a little bit more today. The very bottom of today's run was at 334, I believe, 334.87 around 11 a.m., somewhere around that time. It was 12 a.m. or 12 noon, my apologies. And the high, of course, was at 358.75. So essentially, from the highest of the high on Wednesday to the lowest of the low this morning, we are down about $23.88 on the SPY, or about 6.6%. And about 3.4, 3.5 of that happened yesterday, from roughly about 348 down to 344 or so. Okay, so there's about 3.5% or a little bit more, and then a little bit other drop today as well. And then it came back up. Okay, so this is important to one factor about Edward's question. he had mentioned, of course, that saying with the VIX calls and the some other hedges we might use along those lines, they helped him in February of 2020. They helped me in February of 2018, February 5th, 2018. The beginning of October, end of September of 2018, and December of 2018, where we got to that very bottom draw there before the recovery started in 2000, big jump up in 2019. But those are there for a reason, and I'm going to explain why. So let's navigate now over to power options, okay? And trying to do something here. It's not going to work for us. I'm just going to have to stick with what I've been sticking with. That's fine. It's fine. All right. All right, switch everything over, and there we go. Okay, so what we're looking at here, of course, is your basic 14-day free trial to power options. Those of you just getting started, want you to make sure you take advantage of the 4 steps that are listed here. Access the archive webinars, and of course, go through the free coaching session. Schedule a time with myself or Ernie to walk you through the tools on the site to help you get more acquainted with the various tools and more. Okay, but for Edward's question, we're going to navigate over to the portfolio tools. I'm going to let this come up. Now, I had mentioned I was going to have a discussion briefly here on timing and hedging related to Edward's main question. There we go. And what you're seeing here are the results of long calls that were purchased on 8/24. This is paper trading. This is not real. But how did I find these trades? What I did is I used the backtesting tools and power options for long calls. I went back to Monday, August 24th, roughly 2 weeks ago, and I ran our basic Bollinger Band screen. So these are the top 5 calls that would have matched. Let me just move them over here a little bit. There we go. These are the top 5 calls that would have matched our Bollinger Band screen on August 24th. ACEL, an October 12.5 call. DOW, the 47.5 call for October. HUN, the 23 strike call. RYN, October 30th. October 30 strike, SINA, October 42.5. I chose these calls because, as Edward said, to be under 60 days out in time. Now, interestingly enough, timing and hedging. Ignore the VIX call that's up on the top there. I had to put them all together. Why am I saying ignore it? Well, because remember the chart I just showed you. From 8/24 to the first week when we were down there and then we moved up before 8/31 and before the fall this week, 3 of the 5 calls are at a strong profit. $500, $2,100, $1,330, losing $760 on the SINA 42.5 call, paid $105 for it, and it's currently worth 65 cents. How am I losing $760? If you look here, I wanted to do equal amount into each position. Essentially what we're replicating here is allocating $15,000 to 5 long calls, essentially putting about $2,000 into each to leave cash aside to do management. Okay, so we're down $760 on the SINA call, and we're down $260 on the RYN call. So we're looking at a total, of course, at about $1,020 down. Now, on 8/24, had I bought the VIX calls, I would have looked at the September 23rd 26 strike. Why? Because it was 30 days out in time, and that was the strike that had a delta of 0.3. I believe the VIX was around 22 at that time, maybe a little bit lower. Okay, but the 26 call, highly inflated at 350. But right now it's got a gain of 215. And this morning, its high of this morning was almost $10. So we're close to a profit of $650, which negates close to half of the total loss of these 2 positions, right? That $1,020. So with that profit there we would have had of around $650, that would have taken out half of the loss. And that's the type of hedge that I'm looking for. Now, puts on SPY at the same time, 30 days out, or equal to the expiration of the long calls, the 322 SPY put, delta again of 0.3. Same time frame as the long calls I'm trying to hedge. Well, this only has a gain of $113, so that's only half of this. And as you can see, it's still up on the day. It didn't drop back down as things started to move back up. What I actually did recently, because I thought VIX calls were overpriced. And there's another reason for that I'm going to get to in a moment. And it looked to me that the puts on SPY were overpriced as well. I did actually buy just shares of UVXY. Okay, I don't have to worry about an expiration date. What is this 436 here and the 350? Why am I only buying one contract? Or why am I only buying one contract of the SPY put? And it's because this amount represents 3 to 5%. That's about as much as I want to pay for the hedge on this position in this structure. Okay, but interestingly enough here, we see that the biggest bang for the buck would have been the VIX calls in this case, not only because, yes, the VIX eventually caught up and the volatility of the VIX moved, but amazingly, we gave back a huge amount today from when it was at its peak. All right. And it works better than the puts on SPY. And it worked better monetarily than the shares of UVXY with the same investment amount or close to it, that 3 to 5% of the total portfolio value. But overall, we hedged some of the loss on these two positions, as we mentioned, with these hedges, but again, maybe not as much. At one point we were at half, but now we're only about a fifth of the loss that we're taking on these two positions for our SINA and RYN. But this portfolio is still up 22.4% in 2 weeks because of the strong initial run from 824 to 831. Then we had a little bit higher run up where some of these were, this one was, I think, was at 140%. This did hit 100% profit. So those would have been closed, or half of the calls would have been closed at that point to have less exposure in the market. But maybe what Edward's more talking about is, what if we entered shorter term calls this week? So I'll do the same thing. We went back to Monday, used the long call backtesting tools, ran the Bollinger Band screen, and we came up with our 5 calls again that matched the criteria. And I just took the top 5. Okay, I didn't do any kind of look at the stock or look at the results where they were now in cherry pick. I just took the top 5 from each search. And we had CSIQ, which is currently down 680 or 34%. Hey, we've got LOB, Long Oak Bank or Long Oak something. I forget what that one actually is. We'll look at it in a little bit. That's up 61%, $1,200. Qualcomm down 15% or 270. RYN again came up in both screens, but is also at a loss now of 550. Starbucks, gain of 780. So we're up $1,900, almost $2,000 in this particular portfolio, but we're down $1,200, $1,500, $1,600. So we're still probably, the 550 plus the 680. Okay, that's about $1,230. And then, hey, it's about an even $1,500. So we're still positive here, losing 3 out of the 4 trades. So let's think about that. We have a gain here roughly, as I mentioned. The 2 gainers, the 780 and the 1203. Okay, let's just put that at about 1980 positive value. Then, of course, what we're looking at with our losers from Monday's search. Yeah, let me change color. Let's see if that works here. What we're looking at our losers here is we're down 680 and 550. So that's 1230, right? Yeah, 1230 plus the 270. So we're down 1,500. Okay, we're still up 1980. Now, what's our best hedge here? Well, our best hedge is that one contract, in this case, of SPY. On Monday, 8/31. Going out to the 16th of October, equal again to the expiration date with this put. and I go 30 days out with the VIX call, but equal to the expiration date on this put, we would have bought the 334 put for 602. Right now it's at 886, so we've only hedged it by 284. But again, I'm only putting in $600 or 3 to 5% of the total 15,000 portfolio. So again, this is still a profit. This portfolio is still at a profit, and that does take into account the 53 here, the 284 here. But you can see we're up about $400 here from the 2 long calls that have worked well for us this week, even with the decline coming up. And in this case, we would have hedged 284 of that. Okay, all 3. UVXY only gave us $53 of profit on 20 shares. Why? To keep the costs at 3 to 5%. 1 call of the September 30th 30 strike on the VIX at 370. That was the delta of 0.3, which at the time was about 30 days out in time, is only giving us a profit of 110. Here the put actually looks better, and it gave us the best hedge. Why? Okay, and the comment to this, the answer to this, which Edward posed, he sort of answered for himself in his comment. He said the VIX calls and even the UVXY that I was using, in this case, the 20 shares of UVXY, didn't really see that much of a gain because this isn't that much of a decline. Using VIX calls, shares of UVXY, or maybe even an ultra short, maybe the ultra short SPY shares might have worked better than just buying that put with the 0.3 delta. We were down a total of 6.6% on SPY over 2 days from the highest height to the lowest low. But based on closing, from the open price yesterday to where we closed today, moving back up, we're only down about 3.8% in 2 days, 3.9%. This is not a big move. Honestly, this is probably about half or maybe a little bit less than half of the expected correction. What do I mean by expected correction? Well, you've heard me talking week after week for the past 3 or 4 weeks, or 3 weeks really, maybe 4, but 3 weeks. When the bear signal started coming up in the market sentiment, I was saying that Ernie and I feel that the market is overbought, and eventually we're seeing these triggers, and likely we expect a 7% to maybe a 10% decline. Is this the start of it? It feels like it, but we're not sure. We're going to see some bouncy, choppy markets. But a 7% correction over a 4 or 5 day period, or a 10% correction, is not the black swan events that we saw at the end of February into March 20th. It's not the black swan event and fear that we saw from February 5th to February 9th, 2018, start of the talk of the Chinese tariffs and trade wars. It's not the fear that we saw at the beginning of September the end of September 2018 to that disastrous October. Then we saw some flux in November and then a hard crash in December. That's what the VIX calls are for. This is a decline, yes, but it is much more, Edward, of a gradual and expected decline as opposed to an moment, lack of a better term, or a black swan event. This is why it doesn't surprise me that as a hedge, the SPY puts gave the best monetary hedge against the losses we're taking on these long calls, essentially negated this one loss. I'd like the hedge to negate half of that loss, but to do that, you can see what I would have had to do. I would have had to increase this to maybe 7% of my total portfolio, maybe 8% of the total portfolio, $15,000, to get that hedge to be 564 to counter half of that loss that we saw on those 3 positions. But it's not too bad. I mean, taking away the VIX call that's in here just because it's a long call as well, opening positions even Monday, based on on the Bollinger Band screen that Ernie created in the long calls, we're only successful so far in 2 out of 3 of the 5 trades we opened. But because of the large run up in LOB, and again, we're using the same monetary allotment for each position for a balanced portfolio, we're still profitable. Only 6.2%, but as you can see, that's with the markets pulling down and a significant loss here. All right, so that's the discussion on the hedge. You're absolutely right, Edward, where you see that the VIX was flat, The UVXY was stagnant a little bit, but it did get a good return. I'm actually in shares at a better price here than 22.65. I'm at 21.29, 21.27, I think, and that was on the 27th of August there to help hedge my bull puts. Okay. But you're right. This decline made investors nervous. This is a decline. We did see a decline over the last 2 days. It's not major. It's not fear. It's more expected because the market has been so overbought. And we've been saying that, and others have been saying that as well here on the webinars, that the market's overbought. Be careful about investing too much into bullish positions as well. Now, to your question about technicals, let's take our biggest loser here, and that's CSIQ. And let's go to our profit and loss chart, or let's go to the graph, the chart for CSIQ. Remember, this is a position. What date range am I in here? I am in 5-day. Okay, great. I'm in 5 days. So 8:31, when we opened the CSIQ position, we were about here. Saw some run up, probably had a profit here, and then this decline. So where would I have likely started to look to close this position? And it's down lower than it was today at the open. Well, you've heard me mention that usually if I'm opening a married put, or Edward, if I'm opening a long call, I'm going to look for something that's near the upper Bollinger Band, definitely above the 20-day moving average, and has had a positive MACD for 3 days. My trigger points to look to close this position are when those three are violated. And that happened, as we can expect, Wednesday morning. The stock fell below the SMA 20. It dropped well below the upper Bollinger Band and started to get near that lower Bollinger Band. And the night before, there's my MACD crossover. If these are the three technicals I use to get into the position, these are the technicals I'm going to use as a warning to notify me that, hey, I need to be concerned and maybe look to get out of this position. I don't have intraday prices, but the stock did pull back up here. It was above the 20-day moving average here at the end of the day, the end of Wednesday. But the MACD was negative. And the RSI was probably declining rapidly as well. So let's take a look here. Let's go back to the portfolio. CSIQ, we're down, $680 or 34%. The option's at 165. We paid $250 for it. Okay, so times the number of shares. We did 8 contracts here for a full investment of $2,000 on CSIQ. Let me clear out those drawings. Okay, so let's go to the research tool for this particular option. It's loading the history, and you know what? I'm just going to go to the option chain. I apologize. It's got to be faster. No, did it come up? Yeah, it did. Okay. And down here we have our graph, and I'm going to use the scrubber down here to get just a little bit closer in the last couple days here. Here we go. Okay, so Wednesday. What am I looking at? Implied volatility versus the call. What do I want here? I want the option bid. Yeah, see, so right about here, it's interesting, isn't it? Oh, I apologize, 1 second. So on 9/3, the bid was 185, close to where it is now. On 9/2, it was actually at 310. So during the day, it was sort of declining down to 185. Why is that important? Because I could have gotten a better price had I followed my triggers. Maybe 195, maybe $2 during the day if I had closed when I saw my triggers hit. Okay. Now, this isn't expiring today. This is just an idea of if I feel the market's going to continue down because of the news that came out, and on this particular stock, my 3 triggers were hit, then I may have looked to close it the other day, gotten out at a maybe $2, hopefully maybe $2.10, but maybe $1.90, but it'd still be less of a loss than I'm seeing right now. And usually on a long call, personally though, my target for getting out and just closing and moving on rather than managing would be about maybe 40%, 45%. I don't want to take a 50% loss, but I don't want to set a stop at 25% because I'm probably closing half of my positions out too soon when there is a sudden planned correction, or assumed correction, I should say. It's not assumed at all, but an expected correction as well. Okay? All right. Yeah, Sam did comment that on Wednesday the MACD was still positive there on that particular stock, but on Thursday at the open it went negative. In that case, looking at the history, so that's still probably Thursday would have gotten a better price in that case. And I'm going to bounce to William. I know he asked your question after you guys, but this is related to this topic. William says, Michael, you mentioned that you bought UVXY to hedge your bull puts. Can you explain the math of how much UVX you buy? It's the hedge, William. It's not UVXY, but I'll show you that in a second. How much capital you've allocated to your bull puts? Read your mind, didn't I? All right, William, here we go. Now, ignore the long call if possible. Same profit. So this is had I opened bull put credit spreads on Monday, which I did. And these are pretty much close to them. Okay. FSLY is actually at a different strike. All right. But I am in NVIDIA and Facebook. But anyway, here's the case. Monday's positions. Sorry. About $5,000 to $6,000 allocated to bull puts. Okay, based on what I'm experiencing right now and using that percentage of my portfolio, William, that I mentioned to you. Okay, so in general, when I talk about a hedge in this same vein, that's essentially the numbers that I'm using. Am I on? Okay, good. I'm on clean screen. Okay, so it's still roughly the same amount. Hold on one second, and I'll just I'll calculate that for you, because the idea is, what am I trying to do? It's roughly about 5 to 6% of the total portfolio. So it's a little bit higher here. I'm at 453 because that was the price I would have had to pay for the September put that matched my delta. William, it's a little bit more than I typically like to use. Is my screen paused? Hold on one second. Oh, it is. No, you're looking at the right thing, but I highlighted some there. The SPY put was $453. Okay. So I know that's a little bit more than I would normally use in this case for my hedge, but the idea is to hedge with a percentage. And I usually try to keep that around 5%, $300. Sometimes it's more difficult. And sometimes I'm playing an edge where I'm expecting a downturn. Same thing we saw for Edward's portfolio. For the bull puts opened on 8/31, I own a little bit more than 20, and I bought them on the 27th of August, which is a Friday. Yeah, I bought them, no, Thursday or Friday. I bought shares of UVXY to hedge the bull puts, but not just these bull puts. Okay, not just the ones that are expiring this cycle, 7 days away, because I opened them on the 31st, William. This is for the next 2 or 3 cycles, because I don't have to worry about an expiration date. So I think I have double the shares in here because I was expecting a downturn. But again, earlier today, the hedge looked really good. It was up to 28. It almost hit 29, didn't it, Sam? But I think the highest I saw it was at 28.40. And my cost basis was 21.27. Normally what I would do in that situation, William, is sell half. Did it cover the current losses I'm seeing on my bull puts? No, but there's another factor here as well. I'm losing $46 on the Facebook bull put. I believe that's the first one. Yep. I'm losing $375 on the Fastly and $284 on the NVIDIA position. Now, ignore these numbers here, but yes, these are 2.5 point spreads, but the actual monetary loss is not quite yet at 50%. Yes, it's 100% above what the 30-cent net credit was expected here on this one. 7 contracts here, 7 contracts here. Why 7 contracts and why 10? Because of Facebook and NVIDIA are 2.5 point spreads. Fastly is a 2 point spread. Same monetary amount, about $2,000 roughly or so into each position. A little bit less when you factor in the net credit. Okay, so the market pulled back. I'm losing on all 3 positions now with 7 days to go. This is not quite half yet, and this is a little bit more than half the maximum risk. But I haven't closed them yet. Why? Because they're not within my 1% rule. That's another management technique we've talked about. Yes, the stocks have all fallen. Fastly is at 78 with the stock at 80.92 with another 7 days to go, but it's not at my 1% rule of the strike price. Facebook's at 282.73. It's not at my 1% rule of 270. And NVIDIA's at 504, not at my 1% rule of 492 on the strike price of 487.50. So it's hedging, but it's not doing the hedge that I want. In this case, again, obviously, for this type of small decline, gradual decline, UVXY, the VIX calls, not as good of a hedge because it wasn't a sudden, unexpected black swan type of event. That's where the VIX calls click in. Okay, that's where UVXY really kicks in. Of course, VIX calls, they're going to give you that leverage. Okay, and that's the concept as well. Oh, I'm sorry, I thought it was obvious. Sorry, guys. Stuart and Frank just said explain the 1% rule. Okay, I sold the 78 put on Fastly, bought the 76 put. Lower limit 78.80, 1%. If the stock reaches within 1% of my short put strike price on a 2-week spread or a 1-week spread, that might be a warning sign. If that is triggered and I'm at a negative MACD and below my other technical indicators I'd use for bull puts, I'd probably just close the position and move on. There's no point trying to management if it's going the wrong direction and it's within the 1% rule. The 1% rules have not been triggered for these 3 spreads. That's the 1% rule. I don't want to let the stock price get within 1% of the short option strike price. I don't want to let it go in the money for the risk of early assignment. And of course, since these are all reasonably out of the money anyway, in the next 7 days, if the stocks stay where they are, even within a point or two up or down, we're going to make the full 100% we expect on these 3 positions. Hey, that could change next week, but if it changes, then I have my trigger point set, I have my alert set, get ready to move on as well. Frank, no, I do not use a higher percent for longer trades. 1% rule is static, and actually next week when I get to within 5 days or 4 days, I might lower it to 0.5%. I might actually lower it as I get closer to expiration. That's all going to be explained in the full course on bull put credit spreads that will be coming out soon. Okay, so related to that, Sam says he had 500 shares in SQQ. That is the ultra short SQQ, and sold them at the high today and had a fantastic run on it. Yeah, I was trying to look at potentially a married put, Sam. We had talked earlier today via email. I was looking at married puts on SQQ, QID that you had mentioned, and a couple of the other ultras, but they were all at 25% risk, and I didn't want to take it. I thought about SH as well, but it wasn't moving as much. I'm glad I didn't because of the recovery at the end. Okay, Stuart, real quick, and we'll get to the other questions in just a moment. Related quickly to the bull puts. A bull put credit spread consists, of course, of selling a put option and buying a lower strike, receiving a net credit. We call this the pivot. This is the most important part. I really don't care about the 76 strike at all, Stuart. It's irrelevant to me. So when we relate to the 1% rule, we're talking about 1% of the short put strike price. Yes, 1% above the short put. In this case, the 78, Stuart. 1% would be 78.78, or I put in it 78.80. That's the 1% rule. If the stock fell to that price, I may start, well, 78.80 would be here. I may start looking to manage the position following the 8 ways to manage a bull put credit spread. If I'm in a bear call, it's reversed, right? This is a bull put credit spread. So if I'm in a bear call, it's going to be reversed. If I sold the 84, then 84 cents minus my call strike price, 83.16, that's where I'd have my stop on the bear call at the 1%, 83.16, if I had sold the 84 strike. Okay, that's our 1% rule. Typically also use this for naked puts if you don't want to be assigned. If you're trading cash secured naked puts, not to get in the stock at a discount, but just selling puts to get a premium, the 1% rule of the short put strike price is another good idea if you're not trying to buy the stock, but just trying to get the premium. Okay, and that's what the 1% rule is. It's used in covered calls occasionally if you don't want to be assigned. But again, if I'm in a covered call that was out of the money and the stock starts going up to that short call, if it was within 1%, I might look to manage the position. Or I might let it go in the money slightly and then manage that as well.